Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth, is our guest co-host. Then a new dental care product is making a splash in the Canadian and U.S. market, bridging a gap in oral care. We'll talk to its founder about how it all came together. And of course, we want to hear from you this morning on First Call. You can reach us with your questions on North American large caps, and we'll have Alan answer as many of them as he can. That number, it is 1-855-326-6266. We'll open the phone lines in about 30 minutes. And of course, our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. As the review of the Canada-U.S.-Mexico trade agreement looms, U.S. Trade Representative Jamieson Greer says issues with Canada and the U.S. remain. Greer signaled to lawmakers that Washington is not prepared to automatically extend it for another 16 years without addressing specific and structural issues. He added that Canada will need to make policy changes if it wants long-term certainty under CUSMA. The message comes after U.S. President Donald Trump suggested letting the agreement lapse. Transat posted revenue in its latest quarter that topped estimates as well as profit that beat expectations. The company says for fiscal 2026, it expects a capacity increase of up to 8% compared to 2025. Transat says despite certain impacts during the quarter, it still delivered earnings growth for the year. Shares of Micron Technology are surging in pre-market trading, up more than 13% right now. That after the chipmaker posted profit and revenue in its latest quarter that surpassed estimates, with revenue jumping 57% compared to the year before. Micron also issued an upbeat forecast for the current quarter, citing surging demand and supply shortages that are allowing it to charge more for products. And now our top line story. Lululemon shares are up as much as 7.6% in Thursday's pre-market session on reports that activist investor Elliott Investment Management has built a stake of more than $1 billion in the athletic apparel retailer. Let's bring in our guest co-host, Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth. Alan, thanks as always for joining us.
Thanks for having me.
What do you think of this? Is this been building slowly, or is it a bit of a surprise?
Well, I think overall change was necessary. At least it seems that way. Lululemon has been struggling, as we all know. Bringing an activist investor usually brings in change, right? We're now talking about perhaps a new CEO, Jay Nielsen, I guess, formerly of Ralph Lauren, and much experience, a lot of experience in retail, possibly coming in. I think that's what the market is possibly excited about. You know, it's funny, when a CEO announces that they're stepping down at the same time that a company reports good earnings, which was the case recently, you got to ask yourself, is the stock going higher because the CEO is leaving, or is the stock going higher because the retail earnings are the earnings that came out? So we're not exactly sure. But overall, you know, Lululemon has been struggling. Obviously, their biggest issues are competition, right? Selling, certain items, whether it's yoga pants or other things, at much cheaper prices. Yeah. And I think that has been the problem with Lululemon for quite some time, as they've expanded away from just yoga wear, expanding into male, clothing, I think footwear, shoes.
Now, yep.
So the more they expand, the more they come into competition with other businesses, other companies, and that brings with it challenges, and that's what we've been seeing.
What kind of success does an activist shareholder have when they push something like this, and how often does the company follow through on when an activist shareholder is being that aggressive? That aggressive.
Usually the stock price has, as we're seeing, a pretty good reaction initially, and then obviously that starts to wear thin a little bit, and then we'll see what the activist investor can push through, whether it's a new CEO, whether it's their choice of CEO, whether it is different changes with respect to the business model in general. But usually they'll ask for, they'll have seats on the board, and then that's how they will push through change. And if you're an investor that owns the shares of Lululemon, change is good, especially when we've seen the results that Lululemon has had over the last little while. Although recently, obviously, we've seen the stock move higher.
Do you know if, like, when activist shareholders do get involved that heavily, is there success?
There tends to be, yes, because change is good, right? Now, the question is, will that be long-term success or is it just short-term success? Usually we see short-term. The question is whether or not Elliott Management or anybody else, any other activist investor, can bring on long-term change, long-term success. And, I think, the magnifying glass is there right now, but over time, it'll be less so. And then we'll have to see how Lululemon can compete with other retailers. And right now, it has been struggling.
And with Jane Nielsen as a potential CEO, could you see the company try to go high end? I mean, she's worked at Ralph Lauren, she's worked at Coach, she turned Coach around, she's made Ralph Lauren work. Could you see that?
That's a great question. I think for many, Lululemon has been a little bit on the higher end of things, right? Spending a lot of money for, when they first started off, yoga pants, when you could probably go to Walmart and pick up something similar, maybe not as good quality, but something similar. And that has always been the knock against Lululemon. So going high end, I think they've been in that area for a while now. Could they go even higher? Be coming from a Ralph Lauren, I guess anything is possible. I think they're just going to have to see where their customers are, where their price points should be, and go from there. Obviously, Jane Nielsen has the experience of turning around companies in the past. And the hope is that, I guess, for investors, that she'll do it again if she is obviously appointed as CEO. And
of course, there's still lots to happen before that
That's right.
actually happens. So it sounds like, will we see much movement in 2026 with this? Could it happen that quickly?
I think it can happen very quickly. Just the fact that is the talk, it could happen very quickly, I think. But we'll have to see. Time will tell.
Yeah, because she's not, I don't even think she's working. She's former, so I don't know if
That's
she's
right.
actually
I don't think she is.
Which means there's probably very few restrictions on where she can go, what she can do.
Right, exactly. I would think there could be some restrictions, but, as I say, activist investors have a way of really pushing the envelope, which is why usually when an activist investor gets involved with a business, big business, like a Lululemon, you tend to see stock prices moving higher based on that alone a lot of the time, let alone perhaps bringing in a new CEO. So if you're a shareholder, activist investors are a good thing usually.
Are there any disasters that come to mind when an activist started pushing? You think, put you on the spot there for a second?
Usually I would say that initially the news is good for the shareholders, but longer term, a lot of them don't have the same effect over time as they have in the short term. So we'll see what Elliott Management can do to turn around this business. As we said, I think they even have good earnings. They projected good earnings going forward. So it's not as a bad or a big a turnaround as maybe some of the other times.
There's a base there.
There is, to move from. I don't think the story is that bad. I think Lululemon is a fantastic company. I used to own shares, I guess a little way back. Don't own any at this point in time. I just think overall retail is a tough industry, a tough business, especially now, right? If you have an economy that is slowing here in Canada and the U.S., are people going to want to go out and spend a lot of money on different types of clothes? They might be shopping other places.
We also have the K economy. Okay, lots more to talk about. We're going to take a break, though, but we'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We will start with the U.S. futures, and you can see all of them are in the green right now. Traders are awaiting fresh and overdue economic data, including inflation coming up shortly. But right now, the Dow up by 0.14, NASDAQ up by 0.8% roughly, and the S&P 500 up by 0.4. Moving over to Asia, mixed bag over there. Profit-taking and tech sector weakness influencing the markets there. Nikkei down by more than 1%, and CSI 300 the same, down by about 0.6%. Hang Seng a little bit in the green by 0.12%. In Europe, the Bank of England narrowly agreeing to a quarter-point rate cut to 3.75%. FTSE off, it's pretty much a wash right now. CAC Carol up by 0.1%, and the DAX up by 0.2% right now. And the TSX down again slightly yesterday, almost a wash in fact, but still the fourth day of declines, and it's off 1.3% from its record high set earlier this month. So who were some of the winners and losers? Cargojet surging 6.26%, and Baytex Energy up by 4.6% almost. TransAlta off by 5.4%, and Toromont down by 5.64%. Taking a look at the metals, all of them in the red right now, still in record and near record territory right now. Safe haven still the word. Gold's off by 0.55, silver off by 1.2, 1.3%, and copper down by 0.6. And looking at oil, of course, after multi-years lows, oil saw a bump on the U.S. blockade of certain Venezuelan oil tankers, and WCS closed up 1.81% yesterday, but still struggling. And today, trend continues for WTI. It's back up above 56 after hitting 5-year lows, up by 0.64%. We're back now with our guest co-host, Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth. And Alan, we're going to look back on 2025. Not much happened. There was about 17 years, I think, jammed into 1 year this year, wasn't there?
Unbelievable.
Remember April?
Yeah, you know what? It seems like another year ago. But yeah, I think when I look back, the question that I get often is, what stands out? What surprised me in 2025? Well, I think the resiliency of the market, right? How often do you have the S&P 500, for example, down almost 20% by the end of April, and then by, let's say, 6 months later, it's actually higher by 15% on the year. And unbelievable, right? We went through the tariff wars, if you will, tariff announcements, the trade negotiations, which are still ongoing. We're talking about Kuzma right now, I guess, coming up for this upcoming year. Just the markets, how resilient they've been, and obviously on the back of technology, right? Yeah. Artificial intelligence, AI, those two letters, I think, have been spoken across many shows, many dinner tables, many investors' portfolio reviews. Where has big cap tech been? How has it done? Where would we have been if big cap tech did not come to the rescue over the last couple of years, I guess starting back in 23 even. So I think that to me stands out. And it's been, like you said, at times an unusual year in that what we normally expect from a seasonality standpoint.
None of it exists.
None of it happened. We always expect the markets to kind of have a bit of a pullback August and September. Didn't happen. The market surged higher. November, historically, the best month of the year by far for markets. And we saw a blip downward, a loss in the middle of the month around 6%. And now December, here we are. Markets are kind of wavering again. And again, December normally is a good time. November, December, January, 3 months in a row, best months of the year usually, and we've not had the best start to that 3-month period. So it's been a different year to say the least.
Let's start with the trade and tariffs. In Canada, they haven't had. Everybody was predicting doom and gloom. I mean, essentially got the Liberals elected, elbows up, and doom and gloom, and we're all going to die with the tariffs. But it really hasn't unfolded that way. But we're starting to see the impact, aren't we?
Well, I think we're seeing the impact, but you're right. It's been slightly, muted. It hasn't been as bad as what we would have thought. Obviously, I think Kuzma has kind of saved the day, right? Because when you think about how much or what we send down to the U.S. from Canada, about 85% was protected or is protected under that agreement. Now, that is why the negotiations that are now starting to take place are so important coming up this coming year. Will things change? Will the president just walk away from the deal? Can he walk away from the deal? I think there's some talk about that. If they do, what will then happen to the price of goods coming from Canada into the United States? And keep in mind, I'm sure a lot of Americans are quite nervous about this as well. A lot of border states are quite nervous. So it's not just us up here. If costs continue to rise in the U.S., I just saw a statistic, I think just the other day. I know the president gave a speech last night, but his approval rating on the economy is down into the mid 30% range. So for me, I think it's, he may bluff and say, well, he could walk away.
We're hearing some more of it in the last couple of days again, too.
Yeah, I just don't think it's going to happen. I think it means and will mean a lot more to his presidency, his legacy, and the midterms coming up next year than what he leads on. So for me, it's going to be about trade, at least to start the new year. And like you said, it hasn't hit home yet because of the trade agreements that we have already in place. We actually, as a country, probably have the lowest tariff rates of any country in the world because of Kuzma, our USMCA.
All right, and AI. I mean, everybody. You just said, that those two letters have showed up more often than anything right now. Did those companies have as good a year as we think they did?
I think they did, and I think actually even better than anticipated. You take a name like NVIDIA, right?
Yeah.
The granddaddy of them all, the biggest company in the world, biggest chip maker in the world. they reported earnings that just we had never seen before. At one point, NVIDIA made up almost 10% of the S&P 500 on its own. The Mag 7, over 20 trillion in value. That is more than the Chinese economy, just 7 stocks, bigger than the whole Chinese economy themselves. So I think, yes, they did. But why we may think, well, did they do as well as we thought? Because as they continue to do better and better, the bar rises.
The expectations.
The expectations rise. And at some point, you just can't meet those higher expectations, those lofty expectations. And I think that's what investors are nervous about. I think that's what's holding back a name like NVIDIA, trading now in around the 170 range. Why isn't it at 250? Well, I think people are saying, is this as good as it gets? 62% revenue growth, 80% dominance in market, 75% margins. Can it get better than this? And if it is as good as it gets, where's the stock going to go from here? And I think that is a fear for investors, not just with NVIDIA, but with many names in the AI space.
But your worries rise to the level you're at, almost.
Always. And
because everything's doing gangbusters, but this could go wrong now.
Yeah, and you become a victim of your own success. How much or how long can you grow at 62%? I don't know. What if you only grow at 57%?
Is that failure?
Yeah, your stock probably will fall. So you set that high bar. Can you continue to meet the high bar? And that is the question, I think, for many of these AI companies, AI stocks. And also, aside from all the other issues we've been talking about, the spending, the borrowing, can the borrowing continue? Can the spending continue? Are these companies now over their skis? Names like Oracle, CoreWeave, other names out of the U.S. that are borrowing a lot of money to build these data centers. Is it going to be worth the while? Anytime we hear a delay in the build out of these data centers, and stocks seem to fall.
And I know this conversation will continue in 2026. All right, we got to take up a break now, but we'll be back with Alan. And like a lot of you, he's got the U.S. Consumer Price Index on his radar. Stay with us. Time now for On the Radar. We're back with Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth. And Alan, you're not the only one alone on this. We're looking at the U.S. Inflation coming out, and it seems like it's going to be around 3 again, but we haven't seen any indicators otherwise. Any concerns?
Not really any concerns. And I think the fact that they've already had their December rate announcement, they cut rates. I think this is going to be more perhaps verifying or verification of what they've done. If we do see a lower inflation rate, I think that will be justification for them cutting rates. And also, it's the first number we're going to see towards next year, right? We're going to get another rate announcement in January. We'll get another inflation number in January. We'll get more jobs data. So there'll be a lot more data coming out. So this is kind of maybe a look back, even though it's an accurate or a more recent number, a November number. But overall, I just think that probably won't matter as much as other numbers we've seen in the past, just because it's one of those things where the data came out after the Fed's announcement. So we'll see how it goes. It could move markets if it moves one way or the other more than expected, but I'm not really anticipating a lot of movement.
And it not gotten comfortable with it, but it almost feels like they've said, okay, this is what inflation's running at right now. But it's starting to wear when it's running at 3% for this long.
Yeah, and one of the things that, the President Trump, he talks about inflation, tariffs don't cause inflation, and prices are not running hotter. And, obviously many of us disagree, because even though, yes, inflation, you might even see inflation come down 2.5, 2.4 in that range eventually in the U.S. In Canada, we're at just above 2%. But that's 2% on top of the 2% last year, on top of the 3% the year before. And when you go back far enough, back in 2022, you're talking 6-7%. You very rarely see prices come down. It's only by how much are they increasing by. And that's really why people today are finding it difficult, right? When you see groceries up 5% on the most recent Canadian inflation data, that hurts. That hurts people. And if obviously your income is not matching the increase, then you have issues. And we talk a lot about those that invest versus those that don't. And you can see clearly those that have investments, those that have been investing over the last many years, they tend to do a lot better in these times of higher costs than those that just living paycheck to paycheck, obviously. So, it just lends itself to, you want to put aside some money for your future and have that as a safety net should prices like we're seeing over the last few years start to move higher.
what number might move the markets, or kind of either way? Like if it was 2.8 or if it was 3.2?
Yeah, I think
is it like a couple of points? Is that what?
Yeah, I think if you get a couple of points to the down or to the upside above that 3 mark, I think if it comes in 2.9, 3.1, it's roughly that 3%. But if you were to get something closer to 2.7 and in that range, I think that would be obviously a fantastic number. Then you would hear the president probably talking about putting the pressure on for Jerome Powell and the Fed to cut rates early in the year. And if it goes the other way, the pressure will be under the president will be under more pressure to lower tariffs. A lot has not been made out of the cuts that he's made recently to tariffs on things such as coffee and bananas and some food items. And I thought the media would definitely pick up more on that. But he seemed to skirt by that. But he's definitely mindful of it. There's no doubt that he's watching his approval rating on the economy, which is, as we said earlier, somewhere around 36%. So definitely a number that the president and the administration will be watching.
And any other economic data coming out that we should be? There's been so much coming out. I'm trying to keep, and we're getting some from October, some from September coming. Is there any other economic data, or is this the one that we want to watch?
This is the one you want to watch. I think the jobs number we received the other day out of the U.S. was also a key number. Again, I think right now markets are always trying to find markets are always trying to find a catalyst, right? And here we are the last couple of weeks of the year. After today's number, there really isn't any more data, in my opinion, that's going to move the markets too much. And I think the market right now is lacking a catalyst to move higher, in my opinion. Perhaps that seasonal factor will kick in, maybe a Santa Claus rally. I was hoping for a bit of a melt higher as we move along, the path of least resistance being to the upside. Unfortunately, the last few days, it seems like the path of least resistance is to the downside. Hopefully that can turn around. We had Micron earnings last night, were exceptional, actually blowout numbers. Yep. And that's moving tech stocks and NASDAQ and the overall S&P today. So we'll see how it goes. But overall, I think we're in a, for the gains that investors have up until now, you're probably going to come in somewhere around there. I don't anticipate much in the way of movement. Of course, if there's a geopolitical event or something, that will move markets. But if everything stays status quo, I think we'll all come in and hopefully have a happy new year.
Okay. We'll take a break on that note right there, Alan, but you'll be back. Stick around. We'll be bringing you a conversation with the CEO of the pet app Rover, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email at firstcall@bellmedia.ca. As the review for the Canada-U.S.-Mexico trade agreement looms, U.S. Trade Representative Jameson Greer says issues with Canada and the U.S. remain. Greer signaled to lawmakers that Washington is not prepared to automatically extend it for another 16 years without addressing specific structural issues. He added that Canada will need to make policy changes if it wants long-term certainty under CUSMA. The message comes after U.S. President Donald Trump suggested letting the agreement lapse. Shares of Lululemon are up in pre-market trading after reports the activist investor Elliott Investment Management has built a stake of more than $1 billion in the clothing retailer. Lulu is currently facing a strategic overhaul and is searching for a replacement CEO the current one, of course, will step down in January. Now, according to Bloomberg, Elliott has been working with a former Ralph Lauren executive who is viewed as a potential CEO candidate. Shares of Micron Technology are surging in pre-market trading. That's after the chipmaker posted profit and revenue in its latest quarter that surpassed estimates, with revenue jumping 57% compared to the year before. Micron also issued an upbeat forecast for the current quarter, citing surging demand and supply shortages that are allowing it to charge more for products. And looking at the markets south of the border, a little bit of a bounce back, at least looking like there might be a bounce back for today. You can see the Dow is up by almost 0.4%. It's been a rough month so far, but the NASDAQ 100 up by a little more than 1%, 1.1 almost, and the S&P 500, it is up by 0.2%. 0.68%. Well, the November Consumer Price Index for the United States was just released. U.S. November core CPI rises 2.6%. There we go, Ellen, the conversation we were having, rising slower than expected. Well, there is an app for everything, and Brent Turner, the CEO of Rover, says Rover aims to become the pet owner's essential app. He discussed global trends in the pet care industry with Bloomberg's Romaine Bostick and Katie Greifeld on The Close. Take a listen.
Need a dog sitter or a cat sitter, dog walker, dog trainer. Rover is number one. We're number one in the United States and Canada, in Europe, and with the acquisition of Mad Paws that we announced recently in Australia as well. And I appreciate the question. We are happy with our existing footprint. I think we are, with this latest expansion, we are focused on country growth. There's always a chance that we will do additional countries in the future, but where we are today, with 100 million pet-owning households in the United States, about 130 in Europe, and adding another 6 or 7 million in Australia, that's plenty of room for growth for us.
Yeah, absolutely. When you just think about how many people own pets, I do want to talk about, you're expanding in countries. As you said, you're happy with your footprint as it stands right now. I know that you've acquired 3 companies since 2024. Are you happy with that current portfolio, or, could you see yourself expanding and potentially being more acquisitive in 2026?
Well, I think we will be more acquisitive, I think. We were happy to acquire Cat in the Flat last year, Goo Dog this year, and again, Mad Paws. The reason we buy companies, at Rover, is because we think we can add more value as a combined entity to addressing customer needs on both sides of the marketplace, both pet parents and care providers, than we can as standalone entities. And we've found something to like in each of the companies that we've purchased, and are excited about all of them. That doesn't mean that we're done. And I think one of the things that Blackstone ownership of the company has opened up for us as M&A as another lever for growing the business. It's always been interesting for us, but we've moved into another gear in this phase of ownership.
I love it. Cat in a Flat. I wasn't actually familiar with that. I'm not a cat person. Katie's the cat person. I'm the dog person. Cat in a Flat, Mad Paws. I love these names, by the way.
Very good.
Yeah. Can we talk about names for a second? The most popular pet names?
I'm ready.
Katie has a cat named what?
Catrick.
Catrick. I don't know what that stands for.
It's Patrick, but with a C because he's a cat.
Okay. And I have a dog, a Basenji, Yenzi, the Basenji. There she is. Look at that. Look at that. Beautiful, beautiful girl there. Milo and Luna. These are the top names in the UK. Charlie and Luna here in the US. Simba and Nayla in France. I could keep going on, Brent. But you tell me. There's Catrick right there.
He's gorgeous.
What's most popular with you?
Well, I am personally a cat person as well. I'm one of the few cat-only people on the executive team. I love dogs. We just don't have any right now. And we have 2 cats, Boxy and Mr. Wiggles. And Little Mister was actually we are also a regular foster family for kittens. And Little Mister was a foster cat that we just could not send back. Although I will say Boxy has chosen me. Cats choose people, one person in the household a lot of times, and she has chosen me every morning at about 9 o'clock. If I'm unwilling to pick her up, I get a good yelling at.
I am curious here, as you kind of expand this business, I mean, how far can it go? I mean, obviously dogs and cats are kind of the primary animals, pets that most of us have, and obviously the ones that probably require the most care. But does Rover become something even bigger than that?
Well, when even back in the days when we were raising venture capital, we used to, one of the first things we would say is, hey, pet care, what's the first brand you think of? And people would say, well, nobody. And we would say, that's right, isn't it? That is right. And we still see that opportunity out there. And every day it becomes, we become more synonymous with particularly what we would call the everyday services. And we think the key to continuing to grow is to continue to focus on customers on both sides of the marketplace. We'll roll additional services. We rolled training this year. We're really excited about its momentum. I think grooming is certainly fair game. Pet adoption is fair game. And so you'll continue to see us do those types of things. We would really like to become the essential app that really needs to be on the deck of every phone for every pet owner, the essential app for all your everyday pet needs.
Brent, I also want to talk about your relatively new ownership. You mentioned Blackstone, which of course acquired and then took Rover private in February 2024. The conversations we've been having all week are about the IPO market and sort of these private equity-backed IPOs finally coming public. When you think about the future of Rover, could you see a return to the public markets?
It's always a possibility. I do want to say about the private equity ownership. We were venture-backed for 10 years. We were public for 10 quarters, and we were wrapping up our second year being private with Blackstone. And I would say without reservation that the Blackstone experience has been the best in terms of the three ownership experiences we've had. And I'd measure that in terms of the amount of time and focus that the executive team is able to spend working on the business and addressing customer needs, as well as the ability to make catalytic investments to grow the business and strengthen it, the flexibility to do that, not only inside the business, but on the M&A front in a way that we almost certainly would not have done as a public company. And so the core thesis that they are operating under, we're certainly experiencing that in the office.
And that was Rover's CEO Brent Turner on Bloomberg TV. Now our phone lines are open. Alan Small is taking your questions on North American large cap stocks. Call us at 1-855-326-6266. And you can email us, first call at bellmedia.ca. The November Consumer Price Index for the United States was just released. For more on it, we're joined by Stuart Paul at Bloomberg Economics. Stuart, thank you very much for joining us.
Thank you for having me.
First number, 2.7, that's overall, and then 2.6 for everything minus energy and food. Surprising numbers.
Very surprising numbers. Major downside surprise. The consensus estimate was for about a 3% headline print. 3.1% for the headline, 3% for the core. So today's number, major downside surprise. Now, I will say we have been expecting both goods inflation to turn over and shelter and just broader services to continue sliding. The thing that really stands out to me in today's report is that the 2-month change in shelter prices was a very modest 0.2%. I think, honestly, that's the most important number in today's report. Very much so the focus in the United States right now, politically, is on affordability. And with shelter inflation slowing, it speaks specifically to the affordability problem, and it speaks to services inflation taking another leg lower. That's going to be the thing that the Fed is really looking at because, again, shelter speaks most to the transmission of monetary policy to the real economy.
And do we know what's driving that?
Well, so what's difficult about today's report is that so much of the data on specific spending categories is absent. But we do know that specifically Fed Governor Steve Moran has been highlighting slowing rent inflation, slowing home price inflation, so owners' equivalents of rents. And when you see shelter inflation slowing, is one of those things that's going to indicate to policymakers that monetary policy might just be a little bit too restrictive, and so that we can get some additional cuts in 2026.
Another number I'm just looking at, the energy index was up 4.2% year over year.
That's right. So energy prices were up. Gasoline prices were actually relatively strong during the month of November. When we look at prices at the pump, it looks like on about a seasonally adjusted basis, prices were up 3%. Typically, you would see gasoline prices falling. They mostly just held steady on a non-seasonally adjusted basis. You then account for the seasonal factor, and that's boosting gasoline prices. It's one of those things that matters a lot for consumers' expectations about inflation. The Fed's mostly going to read through that energy side, and when they look at broader energy prices, they look at oil prices today, they're going to be expecting energy prices to fall tomorrow, prices at the pump to fall tomorrow. And when that's the case, the Fed can just read through some of those gasoline prices that are in today's report.
And what about tariffs? Are we seeing what kind of an impact they're having, or are they having an impact?
Tariffs are having an impact. Goods prices have been rising, whereas typically core goods prices exert a little bit of drag on both headline and core inflation. But we actually have an interesting project. We scan prices for about 1 million different goods. And the goods that are often most affected by tariffs and that are most tariff exposed appear like they've turned over a little bit in October and November. We're expecting peak tariff pass-through to really be in the November and December numbers. So when we see the next inflation report, we'll probably see peak tariff pass-through. And so we do expect to see goods prices to start sliding in the new year. Again, this report is an interesting one. There's very little data actually in the report as a consequence of the government shutdown. So we're piecing together a puzzle that has a few missing pieces. But when we look at the totality of data, it actually looks like tariff-induced goods inflation is starting to turn over right about now.
Okay, and just moving forward, what does this mean for the Fed? I know you said we don't have complete numbers, but what does all this mean for the Fed heading into 2026?
Look, a major downside surprise in headline and core inflation, the turning over of tariff-induced inflation, and a major slowing in shelter specifically, all points to more Fed cuts than the market is pricing in. The Fed marked in its previous summary of economic projections that it expects just 1 cut. The market is pricing in 2 cuts. We're basically expecting 3 or more, and today's inflation report really just adds to our conviction there.
Okay, Stuart, we'll leave it there, but thank you very much for joining us with that update.
Thank you.
Stuart Paul from Bloomberg Economics. Well, we'll take a look at some of the notable analyst calls and recommendations moving the markets. That's coming up. All right, let's take a look at some of the notable analyst calls and recommendations. Jefferies has boosted its price target for Inditex by 30% to the highest among analysts tracked by Bloomberg, on the view that the Zara owner shares will rise next year to reflect the compounding quality of a unique group. Analyst James Grisnick noted the unparalleled store elevation the Spanish retailer is doing, which is resulting in meaningful productivity savings that will help control operational expenses. He also said that Inditex will benefit from the EU's de facto axing of the de minimis exemption on import taxes for low-value packages from July 1. The price target is raised to €67 from 51.5. The new target, 22% above last closing price. PayPal is dropping in pre-market trading as Morgan Stanley downgrades the digital payments company to underweight and sets its price target to a new street low, citing slow progress on key strategic imperatives. Analyst James Fawcett says the previous equal weight thesis was based on views that the online acceptance and industry low attrition, combined with efforts to reduce branded checkout friction and expand Venmo checkout usage, would help the company retain better shares online. However, he notes a decelerating branded usage, growing disruption risk from agentic commerce, and weaker competitive positioning of various products such as branded Braintree and Venmo. The price target was cut to $51 from 74, implies a 15% decrease from Wednesday's close. Stock now has 18 buys, 26 holds, and 6 sells among analysts tracked by Bloomberg. Well, Canada's population fell by about 76,000 in the third quarter, a rare decline outside the pandemic, driven by immigration changes. CTV's Heather Wright has more.
The Prime Minister promised to, quote, get immigration under control, and preliminary numbers from Statistics Canada suggest efforts to curb the number of temporary residents are working. Between July 1st and October 1st of this year, Canada's population decreased by about 76,000 people, mainly due to a reduction in the number of non-permanent residents. The decreases are attributed to record high outflows, with a drop of about 74,000 of those holding a study permit.
We needed to bring our immigration level to a more sustainable level. And at the same time, we've doubled down in budget 2025 to attract the best and brightest in our country.
This decrease follows record rates of population growth between 2022 and 2023, an immigration policy aimed at part in helping companies fill thousands of empty jobs following the COVID-19 pandemic. But the increase also exacerbated existing challenges with housing and health care. While a shrinking population can help alleviate some of those issues, there can be negative impacts too, especially when the changes happen so quickly.
Universities, colleges, builders, they're not prepared for these abrupt changes because population change, I think optimal population change happens slowly rather than quickly.
Experts note this decrease is relatively small, but marks a shift toward attracting newcomers who can contribute immediately to industries like construction and healthcare.
I think refocusing on the permanent paths and making sure that the people who are coming have skill sets that there are jobs waiting for them and there are openings.
More changes to immigration levels are coming, with the federal Liberals vowing to further reduce the number of temporary residents over the next 2 years.
And that was CTV's Heather Wright. When we come back, Alan Small takes your questions on First Call. Well, time for First Call for a Thursday. We're going to take a first email, and it's from George. Any advice on getting into the Mag 7? I think that's on everybody's minds right now.
Yeah, I guess, a lot of people are calling for more of the, the market to kind of broaden out. That maybe the Mag 7 won't be as dominating as they have been over the last few years. I'm not so sure about that. Obviously, the Mag 7 make up such a large, as we said earlier, 20 trillion in assets, or in market cap, I should say. I still believe that you can get into a number of these Mag 7 names. A lot of them are actually trading cheaper today than they did a year ago, whether it's an NVIDIA, whether it's a Meta, Microsoft, Amazon. Those are the names that I think you can get behind. And heading into 2026, I think a name like Meta, for example, I think is on sale right now. I know Microsoft is down almost 15% from its highs. And NVIDIA also down over 15% from their recent highs. So I actually think you can buy selectively some of the Mag 7 names. Obviously, names like Tesla are at all-time new highs and continuing to go higher based on their robo-taxis and this promise of robotics down the road. Not really trading much as a car company anymore. In fact, their car production is actually down. So you're buying Tesla, part of the Mag 7, as kind of a future potential for what Elon Musk says will come down the road. So yes, in general, I think you continue to buy Mag 7, but selectively. I don't think you want to own all 7, but I think if you pick and choose, there are some really good names on sale right now.
Any potential headwinds for them?
There are always headwinds, but I think as long as the AI story continues, which I think it will in 2026, I think these names will continue to flourish. The amount of spend that these names, the Mag 7, the amount of money they're spending on AI, data center, infrastructure, is just outrageous. And all predictions are for this to continue. And so if that's the case, then yeah, I think these names will continue to move higher. Okay, but here's what we're going to bring in from Shane, though. Oracle, the stock is falling. Should I be concerned? Ties in with all this. Ties in with all this, absolutely. And Oracle's falling for reasons about, as we talked about earlier, spending, right? Oracle is spending a lot of money. They're borrowing a lot of money to build out their data center infrastructure. And a lot of people, a lot of investors are afraid that they've just gotten, a little bit over their skis. And their debt themselves, the debt that Oracle has taken on, you can invest in that debt and make bets on that debt. And right now the bets are not going so well. That a lot of investors think that they've borrowed too much. You can see there the chart is showing a 35-40% decline from the recent highs. So is it a name you can look at? I think so. I think Oracle did a lot more and a lot of the great things, even before AI came onto the scene. Obviously, software company and the Ellison family, major shareholders now. Larry Ellison, chairman. I don't think anything. The story will get a lot worse. I think there's a lot more that could happen to the upside with this name, and I think buying in at these levels is a good bargain.
And it has a history. Has it had moments like this before?
It has, and usually when they report earnings, which they did recently, usually the stock doesn't have such a good next day. Although the last time they reported earnings, I guess 2 quarters ago, or the 2 earnings ago, they actually went higher by 36% based on what they saw coming down the pipe. So I think Oracle right now, a lot of the focus is on its spend. We need to get past this. Investors need to understand that the spending is going to continue, and that AI is real and will continue to improve earnings and revenues. And once we figure that out, I think Oracle will go significantly higher.
Okay, we're going to wrap it up there, Alan. Thanks as always for joining us, sir. Have a great holidays.
Thank you.
All the best to you for the new year. I know we'll talk to you soon enough. And that is it for us here on The Street. Thank you to Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth, for joining us today. Andy Bell's up next with the Open, and the markets will open a little more than 30 minutes from now. Have a great day.